Hi, good morning. Great to have you on the show. I guess top on everyone's mind is why this out-of-turn meet by the RBI and what is it that they're going to do?
Yeah, I think it should be more or less a routine meeting, from my understanding. There is a target which has been announced by the RBI, and I'm sure that the government would want to just take a review in terms of how long will it be before the target is reached, or is there any adjustment to the target that needs to be done, etc. I would not read too much into it at this time. There is a time given for the RBI to come back, and I think they've just set up a meeting to do that. So I wouldn't read too much into it at this time.
Right. What is the sense that you get about the markets, the outperformance of India in the last 2-3 months, or at least, since the time this whole Russia issue has happened? How would you essentially, look at the Indian markets versus rest of the world? What are markets trying to tell us with the pricing?
Yeah, this is a very interesting question, and I really would want to address it in two ways. One is that India has outperformed the rest of the world by a big margin. So we are up slightly, maybe 1.5% up to 2% for the year to date, while the S&P 500 in the US is down close to 20%. So this is a huge 20% kind of outperformance over the largest market in the world, and so are the European and the UK markets also significantly down for the year versus where we are. Even within emerging markets, I think there are hardly a few who are doing better than India. However, the feeling in India is that we've not really made much money on the equity markets for this year, because on an absolute level, we are just where we are. But on a relative scale, we've really, really outperformed. What does this now mean for the future? I think that is something which is the question which everyone is trying to grapple with. On the positive side, I think the earnings growth continues to sustain, which means that whatever the multiple be, if you forget the multiple of a re-rating or a de-rating, the earnings growth is pretty solid for this year, and the estimates for next year also seem pretty rosy. Which means if you were to bet on earnings, I think India continues to remain pretty robust. However, we have to understand that the global markets may face significant slowdown, including the US, and that will lead all markets downward because of two pressures. One is that of continuing structural inflation, and the second is of higher interest rates and how long they stay in the economy. So I think it's a very, very complex question to answer at this time. India has sustained valuations simply because of its robustness in earnings, and the future potential of earnings continue to remain robust. While the rest of the world will undergo some growth issues, and if earnings have to be downgraded significantly in the rest of the world, I think markets will also follow. So these kind of differentiated market movements do not survive much in today's world. So I would think that one would want to take it, really one day at a time to understand where the eventual, outcome is likely to be. The only bright spot I see in world markets, especially equity markets and asset markets, is at some point of time inflation is captured and then discovered to be, fought over and won over, and that either the Federal Reserve or the global central banks start to pause, and then eventually to combat the slowdown start to bring the interest rates down. And that's when there is some hope for equity markets all over the world as well. So it's a difficult question to answer at best.
It is, isn't it? But Tushar, at this time, while India still enjoys the resilience, and if I can call it sort of decoupled from what's going on with the rest of the world, what do you think one is safer investing in? So far, it seems like IT clearly is not, because, IT back home is facing similar headwinds as IT or tech globally is, although a lot different in nature, also in certain pockets. But at the same time, banks, homegrown sectors, PSUs, defense, banks, what have you, they are the ones which, are still sitting at, multi-year highs. Do you believe that these spaces or sectors will continue their outperformance run going forward as well? Or do you sense that in the near term, the market could see perhaps some amount of sectoral rotation purely because of the concentration of positive bias when it comes to banks and, some of the other PSU pockets?
Yeah, I think one has to make a distinction between where the robustness of the earnings is and the confidence that the companies will continue to grow, which means that the valuation will sustain. I'm not saying that they will go up from here, because you can argue that some of them are already pricing in that kind of robustness in earnings. But when we talk about technology, I think I want to make a distinction between technology in the US, for example, and the kind of drawdown that most of these companies have seen in the last year. So Meta, for example, is down famously around 64% for the year. That's a huge drop in market value. And I think that is attributed to a lot many other factors rather than what you should look at Indian IT for. So Indian IT is pretty much robust because it is a BAU sort of expense for most companies in the US. And the fact that the multiples that most of the Indian companies trade at are nowhere comparable to FANGs and the technology companies that we talk about in the US. So the softness in technology prices in the US is more to do with the glooming slowdown and the fact that some of these companies may face headwinds, as opposed to in India, where the sentiment really will drive the valuations, because it's not really a difficult proposition to understand that earnings will continue to remain robust. While on your other question on what looks good, obviously auto, as you know, consumer discretionary, defense, manufacturing, all of these sectors have seen significant order inflow. That is where the robustness in earnings estimates is where we are coming from, is likely to be seen. And that is more of a domestic phenomenon, and that will sustain no matter what happens. But again, as I said, the earnings robustness, will it translate into stock price performance? Because there is a valuation and a sentiment factor to be talked about. And that is where the prediction becomes difficult. So if you were to ask me which are the companies which will have robust fundamentals, we can clearly point them out. But which are the ones which are likely to do well, or whether there will be a rotation, I think that will all depend on the global sentiments and how the next few months start to go around. Just to give an example of what I'm trying to say is that if, suppose overnight the geopolitical situation gets diffused, then there's going to be some major readjustment to valuations depending on which part of the market you're sitting in. While on the other hand, if you think that this is going to last for a lot longer than what most people expect, then the markets are headed in a very different direction altogether. So I think that is the range of predictability that we have here, which is very low. And that's why investing in markets like these are very, very challenging at best.
Let's pull up the stock of Nika and some of the other new age tech companies. Nika is down 6% as we speak. It's below 1,000 rupees as we watch right now. And it's taking some of the other e-commerce companies also lower. 991. So Tushar, I know you have a lot of experience. And over these years, you would have learned that, buy cheap and sell high. But what do you make of this recent phase where we had these listings where companies were just compared to sales, nobody bothered about profits? Can you just talk to us about the valuation change that a lot of these companies have seen, whether good business model, bad business model, good capital allocation, bad capital allocation, they have been punished. What do you make of this sector? And do you, have you changed your thoughts regarding investing into them?
Yeah, that's another interesting question, and I think I'd like to bring a little bit of context also, and some of the fact that, as you mentioned, experience will help here. So the last time that we've seen technology companies really fly off from fundamentals and valuations based on whatever, if you want to say, clicks per minute or whatever you want to do, those valuation metrics clearly then did not stand the test of time. And I think there was a miscalculation in terms of the expectation of what these companies were likely to do. And I think that has not changed. So even going forward, throughout this period, there have been companies which have really rewarded shareholders. And of course, they may have corrected at some point of time. But the fact is that if they remain robust businesses and they deliver on the longer term earnings promise, then investing in these businesses continue to remain an attractive proposition, which means that you have to be ready for a rocky ride and to last it out to find out who eventually succeeds, because the winner takes all is basically a strategy which we now know e-commerce as well as some of the technology businesses really point to, which means that you really don't know who the winner is, but can you stay out of it? Probably not. So I think as an investor, one should try to hedge one's bets, take a little bit of exposure, find out the companies that you think are likely to sustain. And I think here is where the distinction becomes a little difficult, because you never know what sort of popularity any sort of technology or e-commerce stream or a segment of the market starts to give, and as a result of which, really tremendously benefits that one single company. So it's a difficult one to say that should one stay out or not. I think definitely one should take judicious steps to understand the business potential. And even if there are no earnings, and as you mentioned, the sentiment drove these stocks up because at that time capital was cheap, and there was a lot of sentiment in terms of longer term growth in front of them. Now the sentiment has changed, and the capital now has become a lot more expensive. So that has an impact on valuations. But does that change the future of the company? No. The future of the company is largely just going to sustain. So the valuations that we see in the markets are really driven by the sentiment at that time. And if one is a patient investor, one needs to understand that these drawdowns and these volatilities are part of the game. And if one has a longer term outlook, then obviously some of the winners will come through. But if you are a institutional investor looking over your shoulder every quarter, I think this is a very tough business to remain in, and only very large diversification will sustain over the long run.
Right. So diversification is needed when you invest in such companies, because winner takes it all. So one or two companies may actually give you a lot of returns, but the remaining 5-6 companies may actually be a pain point. That's what you're trying to say.
Exactly.
Okay. How would you look at the traditional businesses, especially in the metals pack, Tushar? One would say metals prices are high, inflation was high, and they have taken the best. But at the same time, you look at Tata Steel, you look at JSW, you look at Vedanta, you look at any company, they have substantially reduced their debt, focused on expansion, and made their cost structure very lean. So how would you look at that scenario and pricing in what steel and other markets are telling you now?
I think one has to rely on the fact that they are what are known largely as cyclicals, which means that they move in an economic cycle. There is a demand increase and there is a demand squeeze over time, and then supply also makes a huge difference to how these companies actually make. So as you see, when there is a lot of demand, these companies do invest in a lot of capacity, and that capacity doesn't come cheap. So if they have to borrow to get there, if they have to raise equity and dilute other investors to get there, it has a big impact on how companies are viewed at that time. When the surge of demand starts to come off, then they are saddled with this debt, and they find it very difficult to return on invested capital. And then all of their valuations take a severe hit over this period of time. And then again, the cycle starts to turn around at some point of time when the demand comes up. So this is the nature of these companies. So clearly on the very long run, if you look at the compounded average returns of these companies, they're very, very poor compared to, say, some of the FMCG companies or more sustainable cash flow generating businesses. But when the excitement starts to hit you, when the economy starts to boom, then the kind of returns that you get in these companies are far, far higher than any of the other cash flow generating businesses as we know. So I think it is a little bit of a contrast to say that, what's the timing that you need to get right on these companies, rather than to say that these companies, do they deserve a better multiple or not. These multiples are really outcomes of the situations that I spoke about. And I think a judicious investor will try to sense the cycle here. And just at about the time when everything is looking bad and everybody gives up on them, probably the right time to invest. And then, as you say, buy them cheap, but do sell them high.
Absolutely. Tushar Pradhan, great to have you on the show.